So we're going to go into something that sometimes causes a little bit of question because it doesn't make any sense at all why someone would waste money like this. Why would a company lease property but never drill the well? Now, if you've watched my previous videos or if you're educated in this because you have a lease, you'll know that when your company comes and leases from you, they're paying you money to lease it. It's kind of like going out and putting a bunch of offers on houses and going through a bunch of option periods, that little 1 or 2 week window where you pay them money just to take it off the market, and then not buying any of the houses. And sometimes these bonuses can be millions of dollars, because if you think about it, it's typically like around 640 acres in order to drill a well is how much you'll need leased. And so if you're doing 640 acres and you're paying $2,000 an acre for all 640 acres, that's $1.3 million that you're just paying for the opportunity to drill a well. That's a lot. That's a lot. Now, I know that oil and gas does big numbers all the time, but it's a lot for almost anybody, right? So why would you ever spend $1.3 million and then do nothing with it? What would cause that? I worked for 10 years for an oil and gas company that was leasing and drilling. I was the reserves engineer that would keep track of what inventory we had, what the economics was on everything, and help select which wells we would drill next. There's a lot of things that go into what you drill each year. Each year you have a different budget. You have different people in charge sometimes. We went from private to public and then back to private while I was working for that company. You have different investors, like I said, different budgets that come along with those different investors. During that time, commodity prices are going up and down and all around because it's the oil and gas industry and our commodities are crazy sometimes. We operated anywhere from $20 a barrel up to $140 a barrel and everywhere in between. You're making those decisions during that time, and that's over a 5 or 10 year period. And you think about most of these leases are 5 or 10 year leases. So these companies are going out and saying, yes, we're going to drill, but it needs to fit in our schedule. We want the opportunity to think about drilling and to consider drilling and to put it into our schedule and to put it into our budget and do all the engineering involved in creating a well and designing a well, permitting a well, drilling the well, getting it online, getting everything in line for the well to actually start producing. That takes a lot of time. Typically, I think the fastest I would expect from a company thinking about, hey, we might want to drill over here, when they start going out and getting leases in a certain area, I would expect at least a year before the well started producing in the best case scenario. Say that they were on it, like they were hyper focused and they lease it, go out, drill it, do all the things right away. I would still expect at least a year to go by before the well starts producing, because it just takes a while to get it on the schedule, get all the materials procured, get the rig scheduled, get the completion crew scheduled, get the well drilled and completed. I mean, drilling takes probably about a month for most wells. Completing can take a week or more for some of these wells. You might have multiple wells that are being drilled at the same time, and maybe all of those need to be drilled. All of those need to be completed at the same time before the first well comes online. So it's just a long process. Millions of dollars being spent on a lot of these areas, and there's a lot that could be lost if you make a poor decision. Here's an example. When I was working for this company, we had a well that was phenomenal, and it was out in the middle of nowhere. We drilled it because we had to in order to hold a lease, and that is a thing that happens. Like, people will drill a well just to hold a lease. Sometimes it's termed HBPing, leases held by production, because that typically will extend the lease to where there's no more requirement for people to have to drill. And so we drilled a well just to kind of hold this acreage and give us a little more time to figure out what to do. Well, that well happened to be an amazing well. we were surprised. We're like, why is it so good? And that happens a lot of times where we make money despite our own best efforts not to sometimes, or figure it out after we drill. It's kind of like the weather, where the weathermen have an idea of what's going to happen, but that doesn't mean that they're not surprised. And maybe they can figure out why they were surprised afterwards, but it's only after you have more data that you can figure out what's actually going on. And so that's a lot of times that's what happens with oil and gas, is we have an idea of what's going to be downhole and what's going to happen when we drill this well, or else we wouldn't be drilling, $4 to $10 million wells. You need some type of return on your investment when you're spending that much money, but we don't know all the answers. There's risk involved. All of this stuff is thousands of feet underground. We can't see it. It changes by the foot sometimes downhole on what the quality of the rock is, what type of rock you're in, what type of reservoir reservoir you're in, how good the reservoir is. If you think about going on a hike, and as you're hiking, you come across this little stream, and on the edge of the bank, you have like kind of muddy, shaly stuff. And then as you go into the river, you get to like more gravel. And then the middle of the river has these big boulders. And then you kind of keep walking through, maybe it's like, only a foot deep or something, and you can walk through it, and you just see different types of rocks as you're walking through the river. That is what's happening downhole. Maybe not to that extent, but a lot of times old riverbeds make great reservoirs. So it's a matter of finding chunky rocks in the middle of the riverbed. As best as we can to know what's going on downhole, we only know so much. And so the unknowns and that uncertainty has to be factored in when we're planning on drilling the well. Back to the story, this well surprised us on how good it was. We didn't think there was any reason for it to be this good, but long story short, it was amazing, and it continued to be amazing for years after that. So we're like, holy cow, this area must be much better than we thought. So we went out there and leased as much as we could, because we're like, this area is amazing, we're going to build the company on this area. So we went out and leased a whole bunch of acreage in this certain area. All of that came with the same like primary terms and rules and reasonings as to what we have to do, and how we have to operate that area, how many wells we have to drill. Along with that, there were marketing agreements, the pipelines, the things that take the gas from the well to the plant where you get the money for it. So you have to have a way to get that oil and gas to someone who's going to pay you for it. Oil's a lot easier because you can just take a truck out to it, regardless of how middle of nowhere it is. You can just drive an 18-wheeler out and put the oil in a truck and then drive it away. Gas doesn't like to be transferred in tanks, and so gas is normally transferred in pipelines. You have to have a pipe connecting where you're wanting to drill all the way to where you're wanting to sell it. Historically, if you didn't have a pipeline and you were only interested in the oil, you could flare it, but that's not an environmentally sound long-term. There's also regulations as to how much you can flare. Just from a economic standpoint, why would you want to just burn energy that you could sell? Ideally, you have a pipeline. That's infrastructure. It's like building a road to a subdivision that you might not ever create the subdivision for. You still have to get there somehow to determine if you're going to build a house there and sell those houses out to the subdivision. So there's infrastructure that has to be built. Now, we started drilling this area and quickly found out that not all the wells were that good, and it actually was as bad as we thought it was originally. It was just one weird well, and that happens all the time. Things surprise you and you can't actually ever figure out why, and eventually you do, but it's too late to really do anything about it. We had all these leases that we had leased, thinking that we were going to change the trajectory of the company, and all of a sudden it didn't make any sense at all to drill a well. You drill a $5 million well and you'd get $2 million of production out of it. And I don't know how good you are at math, but losing $3 million per well, or however much it was for that particular well, is not something you want to do. So regardless of how much money you've invested in doing this project, you don't want to invest anymore. You want to cut your losses, stop the bleeding, move on. There's something called point forward economics. You have to look at that point forward on how much you would get by investing more. Now, sometimes you're so far down the rabbit hole, you've invested so much money already that, okay, if you knew everything you knew, you wouldn't do it again, but you're so far down it that the remaining amount to be spent makes sense to do, because it'd be like if you had to drive 10,000 miles to open a box to see how much money was in it. If you knew that there was only $1 in that box, you wouldn't drive 10,000 miles to go open that box. But if you were only 3 feet from the box and you knew there was $1 in the box, would you open the box to get the $1? I mean, you probably would. I would, at least. The further away you are from that box, the more money there would have to be in order for you to continue going, right? So if you're 100 miles away and there's $1,000 in the box, that's a different decision for you, and it depends on your financial situation, which is what happens in these companies, where they might find out more about these wells as they're going down the process and learning more about wells. As wells produced, you get more information. Pressure and rates tell you things about the reservoir that you might not have known before. And so you're gathering information as you're deciding which wells to drill next. And it might get to a point where, okay, well, if we knew the wells were going to look like this, we wouldn't have leased, we wouldn't have built the pads, we wouldn't have put all this facility work down, we wouldn't have connected pipelines to this area. But since we did, we might as well put the wells online. Or sometimes that decision is made after they drill the well and they see the log, they see the quality of the reservoir that they just drilled through, and they're like, okay, well, we have $3 million more, $5 million more on the completion. Is it worth that? And I know we just spent, $3 or $4 million drilling the well, But if we're not going to if the economics to move forward doesn't make sense based on what we just saw, let's not continue spending money. Let's just stop. And a lot of what they call DUCs, drilled uncompleted wells, just sit there because that happened. And now it might be that the reservoir ended up being bad. It might be that commodity prices crashed halfway through. Maybe the company went bankrupt halfway through drilling the well and they just didn't have any more money to spend. But usually it's because if something happened, they spent money and then stopped. It's usually because the point forward economics said to stop. Said, hey, regardless of how much money you put into here, the amount of money that's remaining does not make sense to spend based on how much we think we're going to make on this project. Those decisions are being made each step along the way, ideally. Sometimes people just put their blinders on and say, here's our plan, let's move forward, and then we'll look at it after the fact and do a look back and say, hey, this didn't make any sense to do. Why did we do it? Let's not do it again. But normally throughout the process, you're continuously checking and cycling back and saying, hey, does this make sense? Is this economic to do? Should we continue? What do commodity prices look like? What do future commodity prices? What do we expect them to do? What does the market look like? What can the market handle? And you're making decisions along the way. Proportionately, leases are one of the smaller components of drilling a well. So if you think about a well costing $7 to $10 million, one of these horizontal 2-mile laterals, that means you're drilling a well down and then across 2 miles. This is what kind of the typical Permian Basin or North Dakota, Oklahoma shale area wells. If that happens, and we go back to that example where you spent $1.3 million on the leasing, that portion of it is much smaller. Also, it usually comes from a different budget than the drilling and completing. So you have your acquisition costs and then you have your development costs, your capital costs. Those are two different buckets. And so sometimes it's just a matter of left hand and right hand not talking to each other, not including those lease costs in the well cost. Full cycle, they call it, from first time talking to the landowner to the last drop of oil made from the well. Yeah, you would include all those costs. But a lot of times you already have the leases and it's two different people making those decisions. Or there's just a lot of complexity that happens when you're making these decisions on what to do. And the fact that they're in two different buckets means something. For right or wrong, a lot of times companies are judged based on how much their acquisition costs were, how much their capital costs were, or how much it costs to drill a well, how much they spent on leasing, how much they spent on certain buckets. And then metrics are made based on those buckets. So one bucket over the other bucket, words like EBITDA are thrown around, or F&D costs, or all those things are metrics that certain investors are looking for. Long story short, it might make the most sense to just let the leases go. And they call letting them expire and letting the opportunity go away, because it just doesn't make sense to do anything in order to hold it. We just wanted the opportunity to do that. Now, hopefully, if you are leasing to someone, you're looking at their likelihood of drilling their lease. And one way to do that would be to look at how active of a drilling program they have, how long have they been drilling, how many rigs do they have running. Sometimes you can find that from their investor presentations. You can ask them, hey, how quickly do you plan, especially if you're actively negotiating the lease, you can talk to them about these type of things. Hey, how many rigs do you have running? What's your lag time between drilling a well and permitting a well and leasing a well? What is the typical time frames between those things? And they might not tell you. They might not know even, but you can ask. And then there's also data providers like Enverus Drilling Info, or Well Database, or IHS, which I now think is S&P. I think IHS was acquired by someone. And so those type of companies have all the records of who's drilling what. They put little GPS units on the rigs so they know where the rigs are and who's operating them. But just know that is the type of analysis that you'd want to do on knowing if how good they are at actually following up on their drilling. How well do you know the area? If you're in an area that has a lot of drilling, a lot of activity, then it should be a slam dunk. But a lot of those areas are already leased. So if you're getting offers to lease now, you're probably in an area that's not a slam dunk. And just expect that these things change quickly, and that's why there's risk involved, and that's why there's such a wide range of values. So that's probably plenty on why companies would lease and not drill. Let me know if you have questions below. I really appreciate the effort y'all have been doing. It means a lot to me to see both comments and likes on the videos, because a lot of times I feel like I am just talking to a camera and I don't see y'all or hear y'all until you give me feedback. Thank you for watching and have a great day.